Happy Friday, everyone, and welcome to What the FICC. Spencer Israel is out today. You got me, Ian Cully, and Jason Purrs is back on the show today. I'm excited to have him with us. We're going to go over a bunch of charts. Of course, we're going to break down, the usual suspects: gold, crude, copper, rates, the dollar. So let's go ahead and knock those out real quick so we can jump into some more exciting charts like Bitcoin back above 30,000. I think that's a big one. I know Jason wants to talk about it. So let's go ahead and get to it. First up, we have gold futures, coming back and retesting a critical level marked by the former commodity super cycle highs from 2011. 1924 is a level, came back, found support, is holding above that level today. It's a little messy though. I want to see gold futures go into the weekend back above 1924. So far, it's looking like that's going to be the case, but we got a long day ahead of us. Gold bugs are dealing with selling pressure right now. Looking at our equal weight precious metal index, this chart looks a lot like silver, equal weight gold, silver, and platinum, heading back towards the lower bounds of this multi-year range. I'm keeping an eye on this chart, keeping an eye on the shelf of former lows, see if we get some buyers stepping in there. GDX looking at, peaking a little early here. I know we have another week to the month of June, but here's the GDX Gold Miners ETF with monthly candles, right back at that 30 level. I'm going to see buyers step in, support GDX, and keep prices above this 30 level. Above 30, it gets messy and downside risks pick up. Moving over to crude oil, still a range-bound mess. But, as long as crude oil is above 65, I don't think there's really anything to get worked up about. Sure, it's below its prior cycle peak from 2018. That's around the 74, 76 level. But it's still finding plenty of support. See if I've lost this crude oil chart. I'm bringing it with me. It's still finding a lot of support here around 65, which coincides with its 2019 highs, a shelf of highs there. So this is a key polarity zone, again, going back to 2019. So as long as crude oil is above 65, my bias, near-term bias is neutral. Longer-term bias, structural bias is still higher. Keep an eye on that 74 level. Above 74, I think we're heading back up towards 83. And when, gasoline futures, still holding above their former cycle highs from 2018, that's constructive to see the derivatives, the distillates, gasoline and heating oil continue to remain resilient. This speaks to an underlying demand for energy and crude oil. USO levels in the USO ETF here, 58.50 on the lower end, and again 72.50 at the upper end of this range. Above 72.50, I'm looking forward to head back up towards 92. On the flip side, below 58, 58.50, and things get messy. Downside risks pick up. I definitely do not want to be holding USO below 58.50. Moving on to copper, Dr. Copper making some moves here in the past week or so, reclaiming this polarity zone, marked by the late or the early September peak here and a shelf of lows going into earlier this year. This is extremely constructive for risk assets globally. International equities, commodities, the whole shebang. Seeing Dr. Copper, with the PhD in economics, catching higher is definitely bodes well for the bull case. As long as it's above 38.75, I like it long towards 4.25. Want to see momentum here. This 14-day RSI on the lower panel here. It is breaking to its highest level, over the past, let's say 5 months or so, but I want to see it get, back above 70. I want to see a bullish overbought print here on the 14-day RSI. Keeping that in mind. Freeport-McMoRan, potential false breakdown here. It's looking like some false breakdown so far. catching higher, as long as it's above 33, I like along towards 45. That's back up towards year-to-date highs. And when it comes to rates, folks, we're still in a rising rate environment. Like, this looks a lot like gasoline, right? 30-year yield looks a lot like gasoline. And as long as the 30-year yield is above 2018 highs, it's really, it's hard to talk about rates rolling over. It's just not in the cards right now. Literally, it's not in the charts. So, if and when the 30-year begins to break down below 3.5, then we have something to talk about. But until then, we're still in a rising rate environment. So, sure, there's a lot of intermarket ratios and intermarket relationships that continue to point towards lower rates. It's been the case for months now. Actually, to the point of starting to get used to it. I mean, there's obviously, there was a point, I don't know about you, Jason, but there was a point where I really kind of stopped looking at the copper gold ratio.
For me, that's not even the case. I always want to keep in mind, because most of the time these things catch up with each other, right? Like, it's not that the copper gold ratio is broken, it's that things get behind each other. Most of the time you'll see that speculators will start to push stocks one direction, and then you'll see something else push another direction, and it always just kind of catches up. So if you were looking at something like yields, copper, gold, we're starting to see copper either bottom out or it's topping out. And then the same with gold. They're both consolidating. So there's no real answers right now. So, there's the Jesse Livermore quote, there's a time to go long, there's a time to go short, there's a time to go fishing. Consolidation is the time to go fishing and just take a break, come back to it when it actually breaks out of these levels. What a lot of traders do on the professional levels is we'll put buy stops or sell stops in those areas. Or, an alert, you stock charts, Trading View, any of these programs that we all use, they have a buy and sell alerts that you can put on certain levels. Put them on there, that way you're just waiting for this to break consolidation one way or the other, then put on the trade.
Absolutely. Absolutely. 100%. I mean, when I'm looking at this chart, what it tells me is that we're still in a rising rate environment, that 10-year yield remains elevated. And then investors are preferring growth stocks right now over value. I think it's that simple.
Yep.
That's just what it is. If anything, don't let these elevated yields steer you away from taking advantage of this rally and growth, right? That's the last thing, I hope, investors and traders out there, I just hope they understand that the intermarket, relationships and evidence are incredibly valuable, but don't let them, sway you from trading what's in front of you.
And the thing that's always very interesting is that you'll see these type of environments happen all the time. And you'll see that most of the time, even in a flat rate environment, growth does very well, tech does very well, and so on. So, understanding that sometimes you're going to have these flat rate type of environments. Sometimes you're going to have environments where things are consolidating. This, to me, what this chart in front of us is telling us is that be open to this. Most likely the yields breaking down over up, because most of the intermarket analysis is going that direction, the copper gold ratio, small cap value to small cap growth. So be open to it breaking down, but also there's nothing to do. So there's consolidation. So wait for it to break down, confirm what's actually happening, and then put on the trade. 100%. But small cap growth and tech and all these things, those trades are already on. Those trades are moving. Those trades are beautiful. You got your buy signals in those long time ago.
Yep, 100%. Looking at the dollar, round out this breakdown here. Dollar's still sideways. Still in between that 105 and 101 levels. Evidence is continuing to pile up and point towards a breakdown in the US dollar. But again, like you mentioned, Jason, you got to have either your stop orders in or just alerts. And until then, when it comes to at least trading DXY, there's really not a whole lot to do. If and when we get an oversold reading here below 30, I mean, I think that will really confirm that we're getting a decisive breakdown on the dollar. And I imagine that's going to be happening when DXY is below 101.
Yes, exactly. That's the same spot I have, marked out. If you're looking at it, basically, if you're looking at just basic trend model, this thing already changed trends a while ago. So we're already looking at a downtrend, but right now we're in the middle of a consolidation in a downtrend, which means most likely continuation to the downside. If we break down, great entry point for a great short in the dollar, or you could express that in other ways, being long the euro, the pound, Mexican peso has been a great trade. You could find many different areas and many different ways of expressing this, but we always want to start with the dollar because it affects everything. It affects global markets. If you're looking at emerging markets, that could be a great area to look at. If this breaks down, emerging markets could be a great long. So the dollar in the macro space is always where we want to look at before just about anything else.
Yeah, I couldn't agree more. And it's interesting to see a lot of these emerging market country ETFs like ILF, Argentina, Latin America, and other areas of the world, breaking out of reversal patterns. I think it's really constructive. We've seen that strong performance from developed markets overseas, and we're seeing that pick up in emerging markets as well. Which I think is very interesting as the dollar nears the lower bounds of this range.
Yeah, and it was a fallen angel pattern. We brought that up the last time I was on. You have the next two highs. It can't get over the old highs. Like it's just a great way to just kind of say, okay, this thing's topping out. Trends are probably reversing. Currencies really do that a lot. So just be ready for a possible breakdown and what that could mean for the rest of global markets.
Absolutely. So let's move on to Bitcoin. We're talking about Bitcoin a little bit. I mean, Bitcoin's back above 30,000. I think that's a big levels. I mean, from a psychological standpoint.
I love the look of Bitcoin right now. For me, it's been I've really been a bull since we got around those lows and started to shift trends. This is my shorter term swing model. I have a longer term model that actually hasn't gotten stopped since that early buy point. But now the short term model is also giving these short term swing signals. I know a lot of traders trade a lot more short term than I do. So kind of coming in and marking it out. The blue lines are the buy signals. Basically, what the system is, it's buying over the zero line on a 50-period CCI, and also confirmed by getting up and over the 40-period moving average. You can also use a crossover system, which is also on there, which is it's a 10 EMA going over the 40 SMA. Both of these systems work great, and they give buy signals right around the same time. But looking at it, it's like, as everybody, and I think Steven posted a great thing the other day. Straza went on and posted this really cool chart, which was all about the news flow being super bearish around all of these points where it started to move back up.
Yeah.
And that's really the truth of markets. The truth in markets is like, if you see something that is constantly shrugging off bad news and moving up through it, that's a strong thing that you want, strong asset that you want to buy and be a part of those rallies. Because most of the time everything works the opposite way it's supposed to. People think, oh, for example, best example that just happened recently, Dogecoin not too long ago. Everybody who bought that thing when they were waiting for Elon to get on Saturday Night Live, and when he was going to get on Saturday Night Live, they were going to watch this thing go to $1 finally, and they were all going to sell and be billionaires or whatever the hell. Like if you talk to any professional traders, like I you could say, hey, the people overseas are going to be selling the shit out of it before any of this happens. The actual traders, you kind of understood that this was going to happen. But even without that, he gets on. Before he gets on, Dogecoin starts falling. When he's on, it's crashing. It's the opposite of what you think, and that was the top. Yeah. So most of the time when we're looking at that type of news flow, we're really trying to be contrarians, going like, what is that market doing when this noise is coming out? And this market of Bitcoin is doing great. It's doing stronger and stronger with bad news. I think it's in a very good uptrend. We need to really clear those major resistance levels. but also you see these major pullbacks. This is also
Mhm.
important to highlight. Bitcoin, when I run a trailing stop on Bitcoin, I am around 35% on a trailing stop. Now, that sounds insane to most people, but you have to understand Bitcoin is the most volatile asset in history. Without a 35% trailing stop, I would have been stopped out on every pullback. So understanding that the positions are going to have to be a lot smaller because it's Bitcoin, so my loss can stay the same, but also opening it up for major upside because Bitcoin goes on 1,000% runs at times.
Yeah.
Like I want to be a part of that if that happens. So understanding both those things, it trades well into profit, and the new swing signal just kicked in.
Yeah, it looks good. It's interesting to you use a 40-day simple moving average
Mhm.
and a 10-day exponential moving average. Is that correct?
Yep,
Why
two
do you
different.
use two different calculations for your moving averages here?
Just back testing. Just simply back testing it, understanding that that worked better in my models than a simple 10-day moving average.
That's interesting.
So that's all it is. So I know it's some people really kind of stick to one or the other. For me,
Yeah.
I always have used an exponential because of that on the 10-day. And then the 40 period has always been a simple. I've just found it to be a little bit more, a little bit better.
So have you in your back test, have you noticed that shorter term exponential moving averages are just are more conducive to the system, while simple moving averages tend to work better over longer time
You
frames?
nailed it. You
Right.
nailed it.
Yeah.
That's the truth. And I think it's just because of, the twitchiness of each product. I don't have a better word than that, the volatility, whatever you want to call it. But because 10 periods are going to, and 5 periods and so on are going to have to be a little bit quicker. The
Hmm.
exponential moving averages seem to work a little bit
Yeah.
better. And being in a long-term trend, you don't want something to be as twitchy.
Right.
So then I'll use a 40, 50, 200. Those are all simples. And I found those to be just a little bit better across the board.
Yeah, just a little more reactive, a little tighter, closer to price when you're looking at a shorter time period, and then just
Yep.
smooth it out.
Smoothing it
Staying in
out.
that trend, with a simple as you zoom out.
Yep.
Cool.
Exactly.
Very interesting. I like this commodity channel index. I'm gonna have to check it out. I'm not a big indicator guy, but I'm gonna look into this.
It's
This
one of the only ones I really like. It's I've always used it. I know a lot of people use the RSI. I found a little, once again, just a little more edge. Just a little more edge.
yeah,
That's basically what turns me onto any certain product, always.
yeah, I like it. Well, speaking of commodities, we're just talking about, and I actually consider Bitcoin a commodity,
Hmm.
currency. Get a lot of there's, I've just noticed on Twitter, over the past, 6 months or so, a lot of noise out there claiming that, the commodity super cycle's dead. There's no way we're in a commodity super cycle. I don't know, what these, just bagging on the potential for, a long-term trend uptrend for commodities. And
Hmm.
when I zoom out and look at, some of the major relationships, big intermarket relationships between the major asset classes, bonds, stocks, commodities. When I see commodities versus bonds, and we talked about this last time, so this is one of the most important intermarket charts out there. I see
Yes.
an explosive rally off of those 2020 lows, a violation of a decade-long downtrend line. And now, it's
Mm.
for the past year and a half, it's been consolidating quite, I mean, it looks like it's consolidating through time, definitely not through price, at a logical level where we would expect to see resistance for commodities relative to bonds. And it looks really healthy to me. I think the pullback that we've seen in commodities is something that we would expect from commodities as an asset. And then looking at the S&P 500 versus the CRB index, and this peak up here in early, was it spring? That was the spring of 2020? It's
Yes.
funny, I can't remember the exact day, but this peak up here is when when crude was trading negative, when zero did not act as support for crude
Yeah.
oil futures. And it's funny, after, we've gotten a significant, correction here in this ratio since last summer, it's finding resistance at a logical level again up here near at 38.2% retracement level, and this multi-year downtrend line. So it all just it seems incredibly normal, incredibly logical to me. And and when you think about just commodities in general, here's a chart of natty gas. I mean, this is what commodities do,
Yes.
right?
This is what commodities do.
Yeah.
That's the best thing, when I talk to people, and when, especially, like, we don't even have to get into right now. Let's just get into the normal part of the commodity cycle. Like what happened in 2020 through 2021. How many 20-30% pullbacks were there in these commodities? There's tons. Look at this one right here in 2021 that you have, like, right here, to down and ending the year of 2021, I think. That was that's what, $6 to $3.50, like that's, we're talking about like a 50% retracement. That is incredibly normal within a commodity cycle. But also the commodity cycle will also go past things like that, like we're in now, and sit in a very different area. And not to mention, we're talking about natural gas here. This is as extreme as it gets. Natural gas is going to pull back to wherever the hell it wants to. It was also, like Bitcoin, one of the most volatile assets in history. But also we're seeing, that this is still holding that higher high here. Is it going to continue to move up here? And not to mention, when we look at energy products, we always have to think of what's the world's view on it? Oil at $100. What does the world think of that? Natural gas going up so much in Europe. What does the world think of that? And when does panic set in? So we did see that, $130 on oil, that creates panic. $10 on US natural gas, that creates panic. So, this is why we see these panics in commodities a little bit more than other places. And those drawdowns can be huge. It's the reason why you have to use stops. You have to have smaller positions and all of these things, and set up your portfolio right to trade them. But also you have to understand, this is normal. This isn't abnormal. It's not like Apple stock or the S&P 500. The S&P 500 loses 50%. It's the end of the world. Like like if it lost 50% as quickly as natural gas could, but natural gas losing 50%, that's a normal day in natural gas.
Yeah, pretty standard. But I think you made an excellent point in terms of ranges. So, and I think this is kind of what you were alluding to or implying, is that we could see some shifts where we create new lower bounds in this cycle. When we're in a commodity super cycle and we start to get these rip roaring rallies, it's going to be messy. Commodities act like yo-yos. You're going to get the big sell-offs, the big rallies. But in that process, we most likely will create new ranges, new levels of support, new levels of resistance that we have yet to hit. Am I following you right?
No, it's perfect. Perfect setup, because that's what we're going to see. We're going to see different new ranges come in at some point, maybe not in every single product, but in a lot of products, So as we see these kind of new ranges get built, as we see this volatility come in, because that's the thing that we're really talking about is, think of a normal day in the S&P 500. 1-2% is like a good big day to the upside in the S&P 500. Natural gas can move 1% in a minute, like very easily. And think about, everybody knows what Bitcoin looks like, so we'll keep going back to Bitcoin a little bit. Bitcoin, obviously, I mean, I've seen 10, 20, 30, 40% days in Bitcoin. That was years ago, but that was possible. To this day, it's swinging around 5% in a day is completely normal. So you just have to understand that all these things have different volatilities. And because of that, you have to set up your trading portfolio in a different way, meaning something like Bitcoin could have a very small position, while something like the S&P 500, which is only going to move in this 1 to 2% range most of the time, I might have a larger position in that. So this is what we're talking about, understanding the volatility in your portfolio, the volatility of each product, especially here, because we talk about commodities, understanding that these are more volatile products and that you'll have to have smaller positions, wider stops to make these profitable trades.
Yeah, absolutely. It was an interesting chart I wanted to share. And this is want to point out, this is the performance of our custom indexes of the subgroups, livestock, softs, precious metals, base metals, grains, and energy. But I want to draw everyone's attention to the far right here of the chart, and just notice that it's base metals and grains that have really been picking up over the past month. And now we've seen these rip-roaring rallies in grains. Copper is starting to perform well. I believe zinc is digging in at a decade long uptrend line. Seen a little bit of a pop in tin, and just other areas. Rebar starting to look like a potential fail breakdown in rebar, which I think bodes really well for just risk assets in general. While precious metals are really rolling over, softs, are consolidating. When I look at sugar, when I look at cocoa, I see some healthy consolidations there. And then livestock, and I want to talk about livestock here. It's just hanging tough. I mean, what a great area to be in. Feeder cattle coming up, retesting 2014 highs. I mean, this is a logical level to see, feeder cattle just chop sideways and consolidate. Live cattle futures posting new all-time highs. It's just, what an uptrend. I look at this live cattle futures trend, and it's just amazing the trends off of the 2020 lows. Again, logical, just an interesting place or logical place to see some sort of consolidation. I mean, we know price doesn't go up in a straight line, as strong as this trend is.
And stay on this chart for a second. The one thing I want to point out too is, when we talk about volatility, there's a huge range there in live cattle futures that Ian is showing right now from 2015 into 2020. And then you see this massive uptrend. And this also speaks to, as a trader, understanding like you're going to have systems or trades that you're going to put on, and they're going to get tossed out quickly. But if you don't have the conviction or the understanding of your system or the risk management to take that next trade, you'll never make your money back. So you have to continue to put on these positions, because these trends do come at some point, as long as you do have a methodology and a system. That 2020 trend right there from that bottom all the way up, that's a beautiful trend for a commodity. That is very hard to see a commodity move that smoothly up that long. These are the trends that we go for. These are the trends that we trade for.
Yeah, this is an amazing chart. I love that chart. You brought a chart with you. I want to jump over to that real quick. I'm starting to run out of time here. This is not it.
It's black. I think it's that bottom one.
Black is the bottom one?
Maybe. Yeah, try that.
This is the dollar.
That's the dollar.
Hold on. This is corn. We're looking at corn here, correct?
That's cattle. This
is cattle. Okay.
Yeah. So yeah, but also, speaking while you look for that, I also want to talk about hogs, because that's trade I also have on and thinking about a bit more. Hogs, what we're looking at here is a COT report. And I think it's incredibly important to have these COT reports ready for trading. You can just look up COT reports. However you need to find them, you can find them. You can see a lot of buying from the commercials. Now, the commercials is the red line, and those are the producers. So the producers, as they are out here and putting on positions and buying more and more, most of the time, they're the ones who see the product every day. They know what's going on. They know who's calling. They know who's buying. They know a little bit more than the speculators, which are the green line. So most of the time, when you see them start to buy at extreme levels like we're seeing now, you'll see that this market will go up, and it will go up a lot higher. So, once again, we want to pay attention to that. So lean hogs have been in a very tight range. Now they're breaking out of that range. That could be another great trade coming up right now in the livestock space.
Yeah, I really like the look of the lean hogs chart. I'm sorry,
Mhm.
I can't find that dual pane chart that you shared earlier.
Oh,
we'll have to bring it up next time. I definitely want to
yeah.
have you back on. We can talk about hogs. I don't think it's quite ready to go. Um, but I think it's something that I want everyone to be aware of in the coming weeks for sure.
Yes. And all I was trying to get at with the corn to the hogs, just in case anybody's wondering, is just basically what we're looking at too is seeing that when we're looking at COT reports as well, corn is getting bought like crazy by the commercials right now. So we have a COT buy signal in corn. That doesn't mean buy immediately. That means wait for the price action to confirm. Now the price action is starting to confirm. This can also start to work the inverse way on livestock because this is feed. So if we're looking at cattle prices being so high, most of the time these things work inverse. So we're going to see if corn is going to continue to move this direction, cattle prices can't continue to just move higher. They will have to level out or go a little bit lower. And so right now we kind of have a trade building up where we're seeing corn has everything in its way to go a lot higher right now. So we're looking at corn pretty heavily. We are long it already. I do see a lot of the grains are starting to look great, like across the board. Soybean oil, soybeans,
Yeah.
everything across the board is looking great. So, all the people saying the commodity rally is over, it looks like it's starting up again.
Right.
Like wheat, yeah, it looks like it's starting up again. Once again, we got commercial buying right across the board in all these products: wheat, corn, soybeans.
Yep.
These people know a lot more than most of the speculators in the market. So if these are they're putting on their buy signals. We're seeing price action confirm it, relative strength running into commodities again. We want to be open to the fact that this could happen all over again. So keep an open mind and be ready for the commodity cycle because it will come back at one way or the other. Maybe this
Yeah.
is a relief rally, but it will come back. It's not going to die off forever.
Looking at that's such a great point, and looking at the commercials holding such a large or a large long position considering I mean they're the strongest hands, they're the biggest short sellers of any of
Mm-hmm.
these markets. So when
Always.
they're buying
Mm-hmm.
or when they're reducing their shorts to extreme levels, like, man, that's a really big piece of information. um
Yes.
for
And
those of you that don't trade futures contracts and want to try to capture this, Pat sent this chart over to me. It's funny, Pat's always trying to turn me on to the equities. I'm always trying to turn Pat on to the futures. Anyways, he sent this chart over to me and he's like, hey Ian, let's look at DBA, look at this basic
nice.
DBA, which I really like. From the chart report, 23 I think is the level here that he's highlighting, back up towards $30. I mean, I'm not crazy about the ETFs. I like DBA.
Mm-hmm.
I like some of the physical metals, like I like palladium, PAL, I like PPLT. I like UNG when it comes to natty gas. But yeah, keep DBA on your radar. And then this is another one I wanted to share before we head out, talking about commodities,
Ooh,
cyclical
yes.
assets, a cycle coming back together. I mean, this is steel ETF. I
Mm-hmm.
mean, still, putting together a potential bullish base here. But again, we were just talking earlier, we got this strong, rally off of 2020. I always like to err in the direction of the underlying trend, Jason. I know you do
Yep.
too.
Yep.
So
Always.
back above 68, and it's commodities, the commodity super cycle hasn't really gone anywhere. I don't know.
Yeah, I mean, and it's
Does.
also there's 2 points I think that's important to think of here. Either way, let's say, oil doesn't continue to go crazy higher or any of these. We're also just seeing sustained levels of inflation either way.
Yeah.
That's what these charts are also saying within this consolidation, whether it's up or sideways, we're seeing sustained levels of inflation in the future. None of these should be breaking down before the commodity super cycle comes to the end, before inflation comes to the end. If we're looking at this, though, it's saying that, we're able to hold up here. Our companies are still profitable here. It's the other thing about it, like something like oil, it's been $40-50 a barrel for a really long time, got it up to 60 once in a while. Sitting around $70-80 is pretty profitable for a lot of these companies.
Right.
So, we're also seeing that these companies are profitable. They're able to hold up in this environment. This is all kind of saying that, you're probably right. We're probably heading back into a commodity super cycle. Who knows exactly when? Right now, there's other things that are trending. We'll concentrate on those as well, but take buy signals as they come in these areas.
Exactly. Take the signals as they come, right? I think it's as simple as that. Yep. Set your orders, set your stops, and set your alerts.
Yep. Go to sleep.
Jason, we could do this all day.
Yep, probably.
I know I could. I could hang out and talk to you about markets all day. I think we're gonna have to wrap it up. Already gone over 30 minutes. I look forward to having you back soon. Please come back.
Cool. Sounds good. I'm always down. This is great. It's a lot of fun for me to come on and chat with you about markets anytime, man. So thanks for having me on.
Absolutely. Where can everybody find you?
So I'm at jpers138 at on Twitter. Also, I run Against All Odds Research. If you go on YouTube, I've been posting videos like crazy in the last few months. So there's a ton of new videos, new content on there. Some interviews with Ian as well. Other traders like Victor Sprandio, and you name it. There's a lot of great traders on there, a lot of education as well as trade ideas. So yeah, check it out.
A lot of great conversations. I definitely recommend everyone get over there, check it out. Thanks again, Jason, for being here today. Again, look forward to having you on again here soon. And everyone, you can check out my work at Ian Cully on Twitter. You can also head on over to allstarcharts.com. I believe we should have some sort of link up there so you click on, check it out. Any information, any questions, please reach out to us at info@allstarcharts.com. And again, thanks for watching. Smash that like button or whatever we do here on YouTube. But thanks again for watching, everyone, and we will see you next week. Have a great weekend.